Hello everyone. If you're learning about investing, you'll often hear people say that diversification is important. It's one of the most commonly repeated ideas in finance, but also one of the most misunderstood. Some people think diversification simply means owning a lot of investments. Others believe it guarantees protection from losses. Neither of those explanations fully captures what diversification actually is or why it matters. In this video, we're going to clearly explain what diversification is, why investors use it, how it works, and what role it plays in long-term wealth building. The goal is to give you a practical understanding of diversification so you can think about risk and opportunity more clearly as an investor. By the end of this video, you'll understand what diversification does, what it does not do, and why it's a foundational principle of investing. So what is diversification? Diversification is the practice of spreading investments across different assets, companies, industries, or strategies to reduce the impact of any single investment performing poorly. Instead of relying on one outcome, diversification allows investors to rely on a range of outcomes. The idea is simple: when one investment struggles, others may perform better, helping to balance overall results. Diversification is not about eliminating risk, it's about managing risk. So why do investors use diversification? Investors use diversification to reduce dependence on any single source of return. No one can predict the future with certainty. Individual companies, industries, or asset types can face unexpected challenges. By diversifying, investors reduce the chance that one negative event will derail their entire investment plan. Diversification acknowledges uncertainty rather than trying to avoid it. So how is diversification different from owning many investments? Owning many investments does not automatically mean you are diversified. True diversification depends on how investments behave relative to one another. If all investments react the same way to the same events, they may still move together. Diversification works best when investments respond differently to changing conditions. It's about variety of behavior, not just quantity. So what types of risk does diversification address? Diversification primarily reduces specific risk, also known as individual or unsystematic risk. This includes risks tied to a single company, a specific industry, and a particular business model. Diversification cannot remove broad market risk, which affects many investments at once. However, it can significantly reduce the impact of isolated problems. Understanding this distinction helps set realistic expectations. So how does diversification reduce risk involved with investing? Diversification reduces risk by limiting exposure to any one outcome. When investments are spread across different areas, poor performance in one area can be offset by stability or growth in another. This doesn't prevent losses entirely, but it helps smooth results over time and reduce extreme outcomes. Diversification turns uncertainty into balance. So why can concentration increase risk? Concentration occurs when a large portion of an investment portfolio depends on a small number of investments. While concentration can lead to strong results if things go well, it also increases vulnerability. A single negative event can have an outsized impact. Diversification trades the possibility of extreme outcomes for more consistent, sustainable progress. So does diversification lower potential returns? Diversification can reduce the impact of exceptional gains from a single investment, but it also reduces the impact of severe losses. For most investors, long-term success depends more on consistency than on perfect selection. Diversification aims to improve the reliability of outcomes rather than maximize short-term gains. So how do different investments behave differently? Different investments respond to different factors. Some are sensitive to economic growth. Others respond to interest rates, innovation, or consumer behavior. Diversification takes advantage of these differences, allowing portfolios to perform across a wider range of conditions. This variety of responses is what gives diversification its strength. So can diversification prevent loss? No strategy can prevent losses entirely, and diversification is no exception. During broad downturns, many investments may decline at the same time. Diversification does not eliminate this reality. What diversification does is help manage how severe losses are and how quickly recovery can occur. So why is diversification important for beginner investors? Beginner investors often face uncertainty, limited experience, and emotional decision-making. Diversification provides a margin of safety by reducing reliance on any single decision being correct. It allows beginners to participate in growth while reducing the pressure to make perfect choices. So how does diversification affect long-term investing? Over long periods, diversification helps smooth performance. Instead of extreme ups and downs driven by individual investments, diversified portfolios tend to experience steadier progress. This consistency makes it easier to stay invested, which is one of the most important factors in long-term success. So what are some common misunderstandings about diversification? Some common misconceptions include that diversification guarantees profits, more investments always mean better diversification, and that diversification eliminates risk. In reality, diversification is a risk management tool, not a guarantee or a shortcut. Understanding its limitations is just as important as understanding its benefits. So how do investors decide how much to diversify? The appropriate level of diversification depends on investment goals, time horizon, risk tolerance, knowledge and experience. There is no single correct number of investments. Diversification should be intentional and aligned with personal objectives. So why is diversification used across all types of investing? Diversification is not limited to one type of investment. It is used across stocks, funds, real estate, businesses, and other assets. The principle remains the same, which is to spread exposure to reduce reliance on a single outcome. This is why diversification is considered a universal investing concept. So how does diversification relate to risk and reward? Diversification helps balance risk and reward. By reducing extreme outcomes, it allows investors to pursue growth while maintaining stability. The goal is not to eliminate uncertainty, but to manage it in a way that supports long-term objectives. So why does diversification require patience? Diversification doesn't always feel rewarding in the short term. At any given time, some investments may underperform others. This can test patience and discipline. Over time, diversification reveals its value by reducing volatility and supporting consistent progress. So how can diversification improve investor behavior? Diversification can reduce emotional decision-making. When no single investment dominates outcomes, investors are less likely to panic or overreact. This emotional stability is a hidden but powerful benefit of diversification. So how does diversification fit into a long-term wealth plan? Diversification supports long-term wealth building by promoting resilience. It allows investors to stay invested through changing conditions, recover from setbacks, and participate in growth over time. Rather than relying on prediction, diversification relies on preparation. Diversification is one of the most important principles in investing, not because it guarantees success, but because it helps manage uncertainty. By spreading exposure across different investments, diversification reduces dependence on any single outcome and supports long-term consistency. When investors understand diversification, they stop trying to predict the future and start building strategies that can withstand it. That shift, from prediction to preparation, is at the heart of successful investing. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.